to meet and listen to Jeff Erickson. Jeff is the Business Development Director for Carta, a leading provider of company valuations and cap tables. And Jeff, you're going to be talking about Equity 101 and just get right into cap table basis for founders, the basics for founders.
Yeah, looking forward to it. Thanks for the intro, Jeff.
You're welcome.
I'll go ahead and share my screen. Can you guys see that where it's Equity 101 for founders? Are you seeing that, Jeff?
Yes, yes.
Okay, perfect. So I'll just introduce myself real quick. Like Jeff said, I'm with Carta, the leading provider of cap table management software on the partnerships team. I'm also an angel investor, a startup advisor, and a former founder myself. I love working with startups, entrepreneurs, founders, and that's where we're going to talk a little bit about equity and what that means to your company today. So the topic is Equity 101 for founders. We'll talk about some of the basics, which include kind of your cap table managing, things like that. But as we kick things off, I wanted to just talk about two types of equity. When we talk about equity, we're talking about ownership in your company. We'll be talking specifically about economic ownership in your company of who owns how much of the company upon exit. But there's also another component to when you talk about ownership, and that's the control or the governance ownership. So keep that in mind as well, that just because somebody has economic ownership does not mean that they have necessarily governance control. That can be done through a board and other things. So when you're looking at a term sheet from an investor, make sure you're looking at both economic ownership and the governance ownership aspects of things as well. So with that, we'll jump into focusing on economic ownership. And one of the questions I get asked from a lot of founders is, what is the difference between common and preferred shares, and which one should I get? The short answer is your common shares in a company, and we're talking about C corps at this point. But if you're set up as an LLC, similar concepts where you might have a certain class of shares, which would be your common shares or units as an LLC, would be issued to your founders, your employees, and people that are kind of in the day-to-day of the company. So that's your common shares, and those would be again reserved for that. It's the difference between your preferred shares is that's typically what goes to your investors. And the reason they call them preferred shares is they have what's called a preference to them. And that means that if there is a liquidity event with the company, then the investors want to make sure they get their money back first. And so they have a preference to getting their money back first before the common shareholders. And so, the preferred shares are more advantageous, especially if things don't go as well as planned for the company. So that's the difference there. For you as founders, you will typically have common shares. Your investors will have preferred shares. The other thing that you run into as a founder is convertibles, especially early on in your setup as a company. When you go out for early stage financing, you may not necessarily want to set a valuation on the company at this point, and you might do a convertible note or a SAFE, which is a simple agreement for future equity. And with the convertibles, they have the option to convert into shares of the company at a later date, and you'll typically have a discount or a valuation cap that would give the investor an advantage for coming in early, but you won't have necessarily set a valuation of the company at that point. They're relying on a valuation be set at the next round, and they'll just take a discount to that. The difference between a convertible note and a SAFE is typically that your convertible notes are going to have a maturity date. So the investor could call that note at the maturity date and have you guys sign or have you pay it back. The convertible notes, they also will typically have an interest rate, whereas a SAFE, the simple agreement for future equity, really just has a conversion mechanism. So at the next round, it would convert to shares and wouldn't necessarily have a maturity date or interest associated with it. In general, convertible notes can be more advantageous for investors. And so you do see that sometimes be forced by the investors, but safes are becoming very popular and just kind of an industry standard as well. So, you know, those are two things. We can answer any questions you have at the end here as well. The other thing that you'll run into as a founder are stock options. So as you start to bring on employees, you may want to give them part of the company or some upside, but you don't necessarily want to give them shares right away. You want them to earn their shares over time. And you can do this through stock options. So your employees will receive what are called incentive stock options, or ISOs, if you hear that term thrown around. Whereas you might have advisors or others that are not employees that you would issue what are called non-qualified stock options, or NSOs. The main difference between the two are that the ISOs for your employees, they have tax benefits that the NSOs don't. And so that's the main difference there. There are some limitations in regards to how many ISOs you can grant to an employee. So if you start granting too many, then the IRS does put some limitations there. But in general, ISOs for employees, NSOs for non-employees when it comes to stock options. And another aspect that you'll run into with your stock options is when you are issuing options, which are not necessarily shares in the company, but the option for the holder to buy those shares at a later date, you need to fix what's called a strike price for your options. And you do this by getting a 409A valuation. One of the main points I wanted to make here for founders is not to confuse the 409A valuation with a fair market valuation that the investors would be looking at. They're two completely different things. Your 409A valuation is a compliance valuation specifically meant for, you know, setting a strike price for your stock options that puts you in compliance with the IRS. Because your ISOs have tax benefits, the IRS wants to make sure you're not setting the valuation on those shares or the strike price too low. And so that's why they'll have you do a 409A valuation by a third party. And so, again, don't confuse that with your valuation of your company at a funding round. Your 409A valuation is something very different than that. The other thing that you'll run into with stock options, and actually also your founder shares, are vesting schedules. And when we're talking about vesting, we're talking about earning your shares over a period of time. So vesting is a concept that as a founder, you want to make sure you put in place for the shares for your other co-founders, and also for, you know, your employees that you might be giving stock options to. The reason that you want to put vesting in place is the last thing you want to have happen as a founder is to bring on an employee or a co-founder and give them, let's say, 10% of the company, and then 3 months later they leave and they walk away with 10% of the company. Vesting is a way to get around that, where they have to vest in those shares or earn those over a period of time. The common vesting schedules you see out there for employees, and often for founders as well, is a 4-year vesting period that's monthly with what's called a 1-year cliff, which means that if somebody leaves within that first year, then they wouldn't receive any of their vested shares. But they would accrue over that period of time. So if it is a 4-year vesting period and the employee hits their 1-year mark, then at their 1-year mark, if it has a 1-year cliff, at that point, they would receive 25% of their shares, which would be 1/4 of their shares at that one point. So that's kind of how vesting works. You can also do things like milestone-based vesting, where, you know, if you have a consultant or somebody that is helping you complete a project or something like that, you might tie it to the completion of a project. but time-based vesting is probably much more common in most cases. So that's a quick rundown of some of the things that you're going to run into when you start to deal with equity and how to divide out the ownership or economic ownership of your company. So the question is, as we go through this, we'll just kind of quickly do a recap. You do your common shares to your founders, and you start to issue that, and then you get some investors that come in that might receive preferred shares. And then you might have a convertible note or a safe agreement that you issue out, and you need to keep track of that. And then you start to issue out, stock options, keeping track of whether they're ISOs or NSOs going to employees or non-employees. And then you want to make sure you're keeping track of your vesting schedules. Again, this is super important to make sure that you're keeping tabs on all of this. And then as you get further down the road, you might have more people join the company, more investors come in, and you start to issue more and more equity and more stock options, more vesting schedules to keep track of. And you can see that it can get pretty complicated pretty quickly as you start to issue out more and more equity. And so the question becomes, how do you keep track of all of this equity and all of the changes in terms of the ownership of the company? And this is where your cap table comes into play. So this is an example of kind of a summary cap table. You can see it keeps track of all of the different classes of shares, the types of equity, whether they're convertibles or warrants, which we didn't talk about, but different types of equity that you might issue out. And then it'll keep track of how things change over time and what percentage each individual owns in the company after each round of funding that's raised or each change to the cap table. So it's important to keep your cap table up to date. So just kind of going over some of the basics of the cap table. Again, it keeps track of how much equity a founder would own or other investors and how that changes over time. It's going to keep track of how much money's been invested in your company over time, what types of shares, whether they're common, preferred, what class of shares, if they're part of your Series A round or your Series B round. So it keeps track of all that. It will also keep track of your option pool and how much you've got left in your option pool to grant to employees or others that might be receiving stock options. And then it'll keep track of the valuation of the company over time as well at each funding stage. So that's kind of a quick overview of what your cap table does. One of the things I wanted to talk about is why is the cap table so important as we start to get into things like that. So in terms of the importance of your cap table, I've talked to a lot of attorneys that have said it's amazing how many times they have to remind founders that they only have 100% of the company to give away. And you can see how this could happen, especially early first-time founders, where if you're not keeping track of the cap table and you promise 20% of the company to this person, 20% to that person, and then you have investors that start coming in and they're getting a percentage of the company, you can see that it might be important to keep track of all of that, because at some point you might find out that you as a founder don't have as much equity as what you were thinking you did. And so again, that's one of the important aspects of a cap table, to keep track of that. Your cap table also help you prepare for future funding rounds. You'll use your cap table to model out what would happen if you took on a round of funding at this valuation and gave up this percentage of the company, and you can see what the impact would be to you and the other shareholders in terms of dilution on your shares. It will also help you keep track of your employee options and their vesting schedules. As you bring on more and more employees, they're all going to have different vesting schedules that start at different times. You're going to want to make sure you're keeping track of that, and that is always accurate. Another good reason to keep your cap table up to date and accurate is to avoid lawsuits. I mean, obviously, if you forget to add somebody to the cap table, um, that's the last thing that they want, but also your investors. If your investors invest in your company and you didn't give them an accurate depiction of your cap table, that can cause real problems. Going back to, well, if you would have disclosed the accurate cap table, maybe we wouldn't have invested. So you can see that it can have major implications if you are not keeping an accurate, keeping on top of your cap table. And then it does help with your investor due diligence. As you're going through a funding round, you're gonna, one of the first things an investor is gonna ask for is to see your cap table. So you want to make sure that that is up to date. So speaking of investors, the other thing I wanted to kind of hit on here is what might turn off a potential investor when they look at your cap table. Because like I said, this is one of the first things they'll probably ask for. And one of the things they'll look for immediately are if there are errors on there. So are there errors on your cap table? You can imagine what kind of indication that might give to a potential investor. And they'll catch errors because they see lots of cap tables. They'll also look for things like how much equity do you as a founder have and how much equity do your key employees have? If they see that you don't have enough, that could be kind of a negative indicator on, man, we see that you're going to have to raise additional capital and it's going to dilute you even further. That could throw up a red flag to your potential investors. They'll also look to see who else is on the cap table. If you've got unreputable investors that they see on there, that can also throw up a red flag, and they may not want to be part of an investment round in your company. So be careful on who you let on your cap table. And then they'll look at things like your liquidation preferences or participation rights with other rounds of funding. They'll be able to see that from your cap table. If you've got an investor that has some really weird terms, that will come up, and they'll definitely dig into that. And then they'll look at things and make sure that things add up. They'll definitely note if you're missing investors or if things are unorganized and don't make sense. It can again throw up red flags when you're trying to raise capital. So keep those things in mind as you're looking to raise capital. I love this slide because it kind of summarizes some of the things that investors will zero in on. And I mean, you can just kind of take a quick look at this, but again, we hit on a lot of these things, but some of the things that founders don't realize that investors can pick up on from their cap table are things like company culture that they might dig into. If they see that that you've issued a bunch of stock options to employees and those employees have left the company, they didn't exercise their options, and you've had a lot of turnover, that's something they'll dig into and they'll say, what's going on here? Can we talk to some of your former employees or something like that if they see that could be a potential red flag. So there's things like that they'll look at. So just be aware of those things as you are issuing equity to employees, co-founders, and others who are going to show up on your cap table. So to wrap things up, I just wanted to go over a couple of tips or best practices when it comes to managing your cap table. The first thing that I advise all of the companies that I work with is to make sure you get a good startup law firm and a great startup attorney. Make sure they have experience working with startups specifically. It's not the same as a corporate attorney that is working with different types of companies, or a divorce lawyer or somebody like that. Startup law is very different and unique. Make sure you have a good startup attorney that has a lot of experience. Also, do things right and do it early. So make sure you set up your cap table at the very beginning and that you keep on top of it as you go. And again, do this right from the beginning. A great startup attorney is going to help you do that. And keep things simple. The last thing an investor wants to see is some weird deal that they don't understand and they've never seen before, that they have to dig into and kind of figure out why you did certain things. So keep things standard and simple if you can. Again, a good startup attorney is going to help you do that as well. And finally, you've got these tools today where you can actually use software to update your cap table and manage things. You can issue equity through the software. It automatically updates your cap table for you. Historically, this has all been done through paper stock certificates and spreadsheets, and it is very prone to error. At Carta, we've seen that it's something like 80% of all cap tables are wrong and have errors in them. And so being able to automate some of those things and having the software sync up with what's actually being issued helps reduce the risk of errors in your cap table. So with that, I wanted to just leave you with a couple of quick resources. There's some great information and resources, as well as some discounts on different products for startups at mystartupstack.com. And also Carta just released something called the Founder Resource Center that has some fantastic information about preparing for your next funding round, about keeping things up to date on your cap table. And I will leave you with that along with my contact information. If you have questions, I'm always happy to connect. Connect with me on LinkedIn. I love talking to startups and working with founders. So Jeff, I'll leave it there if you've got any questions to follow up with.
Well, thanks, Jeff. I think you kind of hit the Equity 101 is a perfect title for this, because I mean, this is so important, and a lot of people, maybe don't recognize that cap table is like huge. I mean, it's like one of the most important things a company needs to work on. And unfortunately, we don't have a lot of time for questions and answers, but I think you're going to get a lot of, hopefully a lot of people will be reaching out to you. It's a really important subject, and thanks for covering it all, Jeff. Appreciate it.
Thanks for having me. Appreciate it, Jeff.
My pleasure. Our pleasure.